Growth of global services trade slows to 5% in the first quarter of 2025. Trump imposes steep tariffs on dozens of countries as deadline approaches. And gold demand reaches 1,249 tons globally in the second quarter of 2025. And welcome to the Economic Bulletin, and I'm Salma Al-Fi'i. We start off with the World Trade Organization, which has reported that the growth of the global services trade slowed to a 5% in the first quarter of 2025, roughly half the pace recorded in 2024 and 2023. Services trade exports in Europe and North America grew by only 3% year on year, while Asia maintained a strong 9% growth. The report also highlighted that global exports of financial services increased by just 3% as heightened economic uncertainty reduced investment activity. However, it added that exports of computer-related services such as AI, digital transformation, and cybersecurity solutions were only slightly impacted by the slowdown due to the robust global demand. And in Europe, the Eurozone inflation held steady at the ECB's 2% target in July, confirming the bank's benign view on prices and strengthening the case for policymakers to keep interest rates on hold for some time after rapidly cutting borrowing costs. Eurostat figures revealed that consumer prices rose at 2% year on year in July, the same pace as in June. On a monthly basis, the prices were flat. Core inflation was unchanged at a 2.3%, though the monthly figure slipped by 0.2%, the first negative reading since January 2025. And among member states, Estonia and Croatia recorded the highest annual inflation rates at 5.6% and 4.5% respectively, while France and Cyprus saw the lowest at 0.9% and 0.1%. And moving on to the economic ties, China's Ministry of Commerce spokesman He Yangdong has called on the European Union to provide a fair, just, and non-discriminatory business environment for Chinese companies seeking to invest and operate in Europe. And he noted that during the meetings last week, the leaders of both sides reached a series of important consensus on the China-EU economic and trade cooperation. Yadong urged the EU to maintain an open market, address the concerns of Chinese companies, and be restrained in implementing trade measures. He further added that China would continue its own high-level opening up, improve its business environment, ensure national treatment for foreign investors, and strengthen intellectual property protection. And now diving deep into Asia, where we have the National Development and Reform Commission, the NDRC, has announced that China's economy saw steady growth in the first half of 2025. The NDRC's Jiang Yi stated that 800 billion yuan for major national strategies and 735 billion yuan in central government budget investments have been fully allocated. He also confirmed the full allocation of the third 69 billion yuan batch of ultra-long-term special national bonds for consumer-grade trade-ins. The final 69 billion yuan batch is scheduled for October, completing the annual 300 billion yuan plan. And thanks to these policies, the ratio of social logistics costs to gross domestic product hit a record low of 14% in the first half of the year, saving over 130 billion yuan. And the International Monetary Fund, the IMF, has raised its forecast for China's economic growth this year, citing strong first-half data and less severe than expected impacts from the US-China tariffs. In its updated World Economic Outlook, the IMF projected China's 2025 GDP growth at a 4.8%, up from its April forecast of a 4.0%. The growth forecast for 2026 was also revised up by 0.2 percentage points to 4.2%. The revision is primarily driven by very strong data in the first half of the year, with growth at a 5.3% and lower tariffs than we expected in April. However, the IMF predicted that China's growth will slow in the coming years, potentially dropping to 3.5% within 5 years without reforms. And Japan's Ministry of Health, Labor and Welfare has indicated the job availability ratio in June fell at 0.02 points from the previous month to 1.22, marking the second straight monthly decline as companies become hesitant to hire workers amid rising costs. And the number of effective job seekers rose to 0.4%, while that of effective job openings was down 1.2% due to the decrease of large-scale recruitment. Separately, the Internal Affairs Ministry reported that seasonally adjusted unemployment rates in June stood at a 2.5%. The number of unemployed people was at about the same level as in the previous month, at a 1.72 million, while that of people with jobs declined by 50,000 to 68.32 million. And still in Asia, the South Korean Ministry of Industry has revealed that exports surged to their highest level ever for July, fueled by strong overseas demand for semiconductors and automobiles, despite the U.S. tariffs weighing on trade. And the country's exports exceeded $60 billion in July, up nearly 6% from the same period last year. Exports of semiconductors jumped 39.3% in July, recording more than $14 billion. Meanwhile, cars rose by a 5-month high of an 8.8% on robust demand in non-US markets such as Europe. And ship exports, however, surged 107.6%. And the Statistics Bureau has reported that Pakistan's consumer inflation accelerated by 4.1% year-on-year in July, up from 3.2% in June, and driven by rising prices for food items, fuels, and medicine. It noted that July's consumer price inflation month-on-month was 2.9%. Earlier, the State Bank of Pakistan Monetary Policy Committee highlighted that energy prices, particularly for gas, had risen more than expected, and it considered the real policy rate should be adequately positive to keep inflation in the 5 to 7% target range. And Microsoft has soared past $4 trillion in market valuation, becoming the second publicly traded company after NVIDIA to surpass the milestone following a blockbuster earnings report. The technology behemoth forecast of record $30 billion in capital spending for the first quarter of the current fiscal year to meet soaring AI demand and reported booming sales in its Azure cloud computing business.
Donald John Trump, do solemnly swear that I will faithfully take office of President of the United States.
Capitol open the emergency and reciprocity.
Mexico, Canada,
Greenland.
And U.S. President Donald Trump has slapped steep tariffs on exports from dozens of trading partners, including Canada, Brazil, India, and Taiwan, pressing ahead with his plans to reorder the global economy. And according to a presidential executive order, Trump set rates including a 35% duty on many goods from Canada and 50% for Brazil, 25% for India, and 20% for Taiwan, and 39% for Switzerland. The order listed higher import duty rates of 10% to 41% starting in 7 days for 69 trading partners as the deadline approached. Trump, however, included an exception for some goods shipped within the coming week. Goods from all other countries not listed would be subject to a 10% U.S. import tax. Trump had previously said that the rate might be higher. And the responses, however, varied widely, starting off with the Canadian Prime Minister Mark Carney has voiced disappointment after U.S. President Donald Trump signed an executive order to raise tariffs on Canadian goods to 35% from 25% on products outside the scope of the U.S.-Mexico-Canada trade agreement. In a post on X, he noted that the U.S. duties and tariffs will heavily affect lumber, steel, aluminum, and automobiles. He vowed action to protect Canadian jobs, buy its goods, invest in industrial competitiveness, and diversify export markets.
Day one of my leadership campaign in January. I'm in politics to do big things, not to be something. And now that Canadians have honored me with a mandate to bring about big changes quickly, I will work relentlessly to fulfill that trust.
And Switzerland's President Karen Keller-Sutter has stated that the country's government had been disappointed to learn U.S. President Donald Trump hit them with one of the highest tariff rates in his global trade reset. And Keller-Sutter noted that the two sides had reached an agreement that both were happy with, but U.S. negotiators had not received Trump's support. She added she had spoken to Trump earlier and that he was focused on the trade deficit the U.S. had with Switzerland when it came to goods amounting to around $40 billion. And meanwhile, Mexico has taken a firm response, with President Claudia Sheinbaum announcing that she secured a pause on new tariffs coming into effect and a 90-day period to work on a trade deal in a call with U.S. President Donald Trump. Sheinbaum stated that the pause safeguards the U.S.-Mexico-Canada agreement and means goods compliant with the pact will continue to be exempt from the 25% tariffs Trump imposed earlier this year due to the fentanyl crisis. Economy Minister Marcelo Ebrard, speaking alongside Sheinbaum, highlighted that agreement brought the countries closer to securing a long-term trade agreement. Moreover, and separately, the White House has stated that President Donald Trump will keep minimum global tariff rates at 10%, resisting prior suggestions he could raise the floor to 15% or higher. Thailand and Cambodia now face a 19% U.S. tariff on its exports. Washington had previously threatened to impose a 36% levy on these two countries. Malaysia was also set at a 19%, and that's on par with previously announced rates for Southeast Asia neighbors Indonesia and the Philippines. Taiwan also got a 20% levy. And Thailand's finance minister has stated that the 19% tariff rate agreed with the United States will help bolster its competitiveness globally and boost investor confidence and create opportunities for economic growth. And he noted that the government is fully aware of the impact on businesses and farmers and has prepared various support measures, including budget allocations, soft loans, subsidies, tax incentives, and regulatory reforms.
อันนี้สิ่งที่เข้ามาขอให้เราทำเนี่ยก็เผอิญเป็นสิ่งเราควรจะทำอยู่แล้วถ้าส่วนใหญ่อย่างหมูเนี่ยถ้าเราไม่เปิดเลยก็อย่างนั้นแต่เรามีความเข้าใจว่า
And Malaysian Trade Minister Tengku Zafrul Aziz has revealed that pharmaceutical products and semiconductors will be exempt from U.S. tariffs. And he added that for now, these goods were exempt, and he viewed this as a win-win for both Malaysia and the U.S., reflecting the good relationship between the two nations. The minister also said that the reciprocal tariff rate of 19% was fair, considering the circumstances, the situation with Malaysia's neighbors, and the global landscape. Additionally, Cambodia's Deputy Prime Minister Sun Chantol has stated that a tariff rate of 19% on Cambodia's exports to the United States has helped it avert the collapse of its vital garment and footwear sector, allowing the country to remain competitive with its peers. He thanked the U.S. President Donald Trump for his understanding in Cambodia's negotiations to reduce a tariff rate. Sun noted that Cambodia had agreed as part of the deal to buy 10 Boeing 737 MAX 8 aircraft for its national carrier, Air Cambodia, with the option to purchase another 10. And for further analysis, we are joined from London by the CEO of the QW Capital, Gianluca Lobafalo. And welcome and thank you for joining me here today. And how do you anticipate the lower 19% U.S. tariff secured by Thailand, Malaysia, and Cambodia will impact, do you think, their export competitiveness compared to countries facing much higher rates, like Canada 35% or Switzerland 39%, do you think?
Yeah, good meeting everybody. Now, we have to be clear on one thing. Here is a very evolving situation. So we had this surprise last night on Switzerland. We had this, as you say, more benign tariff regime for this exported country, particularly we're talking about Vietnam for low quality product, but as well for South Korea. These are essential for the chain of production for all the technology components that is so relevant for the US and global economy, but particularly for the US. Having said that, here we are talking about a situation that is changing on the hour. So we first heard about this new set of rules, and then obviously Mexico is being extended is a pause, and so we are now in 90 days pause with Mexico. On the other side, Canada, right, 25 to 35, but obviously we have to exempt all the one who are part of the North America agreement. So it's still not clear what are the products to be included. I wouldn't be surprised if Canada get an exemption as well. On the other side, Europe, Japan, UK is more or less clear what we are heading to. Having said that, if situation stands as it is, tariffs are definitely better than what we were told on Liberation Day on the 2nd of April, but to bear in mind that are 6 times, I repeat, 6 times higher than what were at the end of 2024. So we are definitely in a more expensive trade regime.
Sir, to what extent do you expect these tariff disparities to divert trade flows? For example, will the U.S. importers shift sourcing from high tariff markets like Switzerland or Canada to maybe Southeast Asian countries that now enjoy more favorable rates?
In reality, the real impact is that it will take longer for the trade, because we still have the biggest consumer in the world with US versus the biggest producer in the world with China. So what you are actually saying is that, yes, it's true, some product, instead of going directly from China to the US, they will go through intermediate step to pass through countries that have a more benign regime. But this tariff at the level, even if in some cases it can be staggering, it won't change the fact that the biggest producer need to send product to the biggest consumer. Now, it will be more complicated, there will be more friction, definitely there will be an attempt to onshoring production in the US. But to me, and I said last time as well, I want to make clear that everybody see what I mean, is that these trade negotiations are just a tool of negotiation. The real bargain, the real focus of the US administration is to take the interest rate of the US curve, so the 5 to 10 year bond below. And this trade negotiation, as below, aim at reducing the cost of funding for the US, who is going in a period of need to refund 7 trillion only in 2025. If we include the first 6 months of 2026, we're talking about in excess of $9 trillion. That's the key game. That's the game in town.
What do you think, sir, could be the significant gap between the tariffs faced by Southeast Asian countries, which is 19%, and Canada, Switzerland, which is 35 to 39%? How could this actually trigger broader trade imbalances or create new patterns of trade deficits? What risks or opportunities might arise, do you think?
I think we're going to see much more macro volatility, particularly on the US dollar. Because don't forget that we are coming out of an 80 years dominance of this privilege that, as Giscard d'Estaing, the French Minister of Finance and then President in France in the 60s, was talking about the fact that the US is experiencing an exorbitant privilege of having its currency as a global reserve currency. At the moment there is this is the question: is the dollar able to continue its 80 years run of being a global reserve currency, whereas the previous one, the longest one, was sterling, who didn't exceed 40 years. So now there is part of the world, particularly the country you mentioned, so the one from the Southeast Asia, who are part of the global South. The agreement has been set up with the BRICS of Brazil, India, China, Russia, and South Africa, who are actually questioning the role of the dollar as the means of exchange for any commodity or global asset. So this is the question linked to then the funding policy the US is trying to influence, reducing the cost of their funding, so the long to mid-term rates. That's are the key variables. So yes, there will be a short-term impact. Bear in mind that Canada, Mexico versus other countries like South Korea we are talking about, yes, it's true the tariffs are different, but the trade relationship between US with these countries is completely different. So Canada cannot be replaced by South Korea the other way around. There are products imported from Canada cannot be replaced by products imported from South Korea simply because South Korea experience now a more benign regime of trade. So it's not that obvious. They are not replaceable.
Well, from London, that was the CEO of QW Capital, Mr. Gianluca Lobafalo. Thank you so much, sir, for your insights. And now we move on to the latest developments from the commodities sector. U.S. light crude oil prices fell more than $1 a barrel in early trade in New York on a possible increase in production by OPEC and its allies. Brent crude futures were down 1.23% at a $70.82 a barrel. West Texas Intermediate crude was down 2.21% at a $67.73. And the World Gold Council has reported that gold demand reached 1,249 tons globally in the second quarter of 2025, Q2, and a 3% increase year on year. In a report, it highlighted that high demand for gold investment was instrumental in boosting the overall Q2 demand. Additionally, it noted that gold jewelry demand volumes declined, but the value continued to rise in the second quarter. The Council pointed out that central banks remained a key pillar of global demand, adding 166 tons to global official gold reserves. It further noted that although the pace of buying moderated, the demand outlook from central banks remains favorable. And gold prices rose almost 2%, hitting a one-week high on Friday after weaker than expected U.S. payrolls data boosted Federal Reserve rate cut expectations, and fresh tariff announcements spurred safe haven demand. Spot gold climbed 1.9% to $3,300 $351.61 per ounce, reaching its highest level since July the 25th. And bullion was up an 0.3% so far this week. And U.S. gold futures rose 1.7% to $3,405.20. And for further analysis, we are joined from Cairo by gold markets expert, Mr. Osama Zarai. Welcome, sir, to Q News' Economic Bulletin. The World Gold Council reports a 3% rise in global gold demand in Q2 2025, driven largely by a 78% surge in investment. How do you, sir, interpret this trend in the context of current global economic and geopolitical uncertainties?
Actually, in the beginning, first of all, welcome to your audience. We can see this global demand on gold from central banks is a worry of two things. First of all, the political situation and worries with what is happening in the world. Second is worrying about tariffs and the vagueness of U.S. administration policies. The second part, the most impactful on the ground, is BRICS and the purchases, BRICS countries' purchases. So today, when we look at gold situation generally, we can see that there is great worries from what is happening. So now are moving. We can see that East Asian countries are the most purchases to gold because of because exchange sports in Shanghai to start new ways away from tariffs, U.S. tariffs. So there are 3% rise. I think expect even an increase on Q3 with August, especially because I think we hit the bottom. I think it reached to $3,500 or $3,200.
Mr. Zari, with central bank purchases slowing, but the overall demand growing, what role do you think the official sector strategies plays in shaping the future outlook for gold?
The future view on gold market depends on more than one thing. Today we see, let's talk side by side. If we talked about the Western role and the U.S. market, the expectations now is the decrease of interest rate in September. As expected, it will give a push to gold market, knowing that American citizen and investor will engage in the markets, which will give a push to the market. Also, the Chinese insurance company that invested by 1% and with its assets, which equals about 300 tons of gold, will be demanded by the Chinese or companies only or insurance sector only. So I think this will increase the demand greatly in the next period. Also, the worries of trade recession will make central banks worry about interest, and there will be great decrease of interest. So the future
and from Cairo, that was the gold markets expert, Mr. Osama Zarai. Thank you so much, sir, for joining us on Q News. And that brings us to the end of our economic bulletin, and here's what we have been covering. Growth of global services trade slows to a 5% in the first quarter of 2025. Trump imposes steep tariffs on dozens of countries as deadline approaches. And gold demand reaches 1,249 tons globally in the second quarter of 2025. And this concludes our economic bulletin. And don't forget to follow Q News on YouTube, Facebook, X, Instagram, and TikTok at QNews EG to stay informed. And thank you for watching, and stay tuned for more updates on Q News.